Hello friends, welcome back to my channel. So today we will be doing capital budgeting. So the first question which arises is, what is capital budgeting? It is a technique of evaluating various capital investment proposal and selecting the best proposal for the firm. By best proposal, we mean the project which is capable of earning higher rate of returns. So capital budgeting in simple term is preparing budget in respect of investment proposal. In other words, capital budgeting is budgeting of capital expenditure. It identifies whether a firm should invest or should not invest in a particular project. Now, for the purpose of investing the funds of the firm in different assets or project, various decisions are to be taken. These decisions are known as capital budgeting decision or investment decision. So, capital budgeting decision is a decision to invest the funds of the firm in the long-term activities in such a way that maximum profit can be realized. It involves determining the most advantageous investment option for the firm. Capital budgeting decision affect the profitability of the firm. So these decisions are of paramount importance. Also, these decisions are irreversible. Means once these decisions are made, it becomes impossible to take them back without any material loss. Types of cash flows. First is initial cash outflow. It can be calculated as cost of new asset plus installation cost minus scrap value of old asset plus if tax effect of profit on sale of old asset and minus if loss on sale of old asset plus increase in working capital plus opportunity cost. Second is subsequent annual inflow. Profit after tax plus depreciation minus capital expenditure if any, and profit after tax can be calculated as sales minus variable cost minus fixed cost minus depreciation minus tax. Terminal cash inflows, annual cash inflows plus working capital realized plus scrap value. So now let's solve a question. A firm is considering to purchase a new machine costing 1,20,000. The installation charges will be 25,000. The decision will result in increase in working capital requirement of 15,000. The machine is expected to provide cash inflow before depreciation and taxes amounting to 70,000 for a period of 5 years, after which it can be sold for 50,000. The use straight line of depreciation. The income tax rate applicable is 35%. Calculate all the cash flows associated with the machine. So here we have to find all the three cash flows, that is the initial cash flow, subsequent cash flow and terminal cash flow. So first is initial cash flow. So calculation of relevant cash flows, and first is estimation of initial cash flow. So it is given that a firm purchases a new machine costing 1,20,000. So cost of new asset that is 1,20,000 plus installation cost. We have to follow this format, that is rupees 25,000. So cost of machine is, this is the total cost, it is 1,45,000. Now it is given that there is an increase in working capital requirement by 15,000. So increase in working capital. You have to write whatever the information is given to you. It is 15,000. So initial cash flow, total initial cash flow is 1,60,000. B is, second part is estimation of subsequent cash inflow. Now The machine is expected to provide cash inflow before depreciation and tax amounted to 70,000. So this is cash inflow before depreciation and tax. $70,000. This is our profit before tax. So now we have to deduct depreciation from this. Depreciation will be 1,20,000 plus 25,000. 1,20,000 is the cost, 25,000 installation cost minus sales value of the asset, that is 50,000, divided by the number of years for the period of 5 years. So the depreciation is 1,20,000 plus 25,000 minus 50,000 divided by 5. 19,000. We have to deduct it from 70,000 and we get what? Profit before tax. So it is 70,000 minus 19,000, 51,000. Now deduct tax from it, which is 35%. So 35% of 51,000. 17850. Deducting it, you will get profit after tax. So 51,000 minus 17,850. It is 33,150. Now to calculate the cash inflow, we have to add depreciation back to it, which was 19,000. So cash inflow is 33,150 plus 19,000, which is 52,150. So your subsequent cash inflow is 52,150. Now we have to calculate the terminal cash inflow. So to get that value, we have to add the working capital realized and scrap value to the annual cash inflow. So let's see what is given in the question. Terminal cash inflow. So we have to add scrap value and working capital realized. So working capital realized, it is 15,000 and scrap value of the asset is given as 50,000. So here it is 65,000. Now you have to add this amount to the subsequent cash inflow. Which was 52,150. So the amount you get is 1,17,150. So this is your terminal cash inflow. So here your question is complete. So thank you for watching it.